stop swinging for the fences. Meaning, I'm not saying you can't 10x your results. I'm not saying that you can't go out there and crush it. I'm saying go hit a single, get off the bench, get in the game, get on base, because as soon as you get that taste that's required probably less money and less risk out the gate, once you get that taste, you now put yourself in a phenomenal position. Real estate is one of the only things that can truly make you wealthy over time, but it's got to start somewhere.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. Half of Americans aren't saving for retirement, and those that do save are saving far less than they'll ever need. This is why, for many of us, we leverage real estate to take control of our financial future. The key is to get the right information to build the future we have in mind for ourselves and for our families. Well, today's guest understands this very, very well. He's a longtime real estate entrepreneur, and he and his business partner have been awarded the prestigious Build Award as the single best family home investments advisory firm in the USA. He is a Forbes contributing writer, as well as a member of the Forbes Real Estate Council. He is the co-founder of Done For You Real Estate, a multi-million-dollar real estate investment company where he and his team have redefined investments for thousands of families through profitable and conservative real estate investments. With nearly 4,000 homes transacted, his group sets itself apart with its one-of-a-kind track record and its customer service as well. Additionally, he is also the author of Flip the Gratitude Switch and is the co-host of the top-rated podcast, Replace Your Income. Now, with all that, I'd like to welcome my good friend, Kevin Clayson, to the show. Hey, thanks for coming on, bud.
Hey, Augustino, thank you, man. What an awesome show. And dude, as soon as we jumped on the Zoom, and I love talking to my bald brothers, you know what I mean? Because we both have what I call being follically challenged, you know, and so I appreciate that. Anyway, dude, I'm so happy to be here. So excited to be able to chat with you and your audience today. Thank you so much for having me on.
Awesome. No, I think it's going to be awesome. Now, if you like what Kevin has to say, you can reach him via his contact page on the website at dfy-realestate.com. And if you like our content, please don't forget to leave a comment and rate the show. It helps us out tremendously when you do. Finally, if you text the word freedom to 202-410-4202, get a copy of our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Kevin, tell listeners a little bit more about your background and what your current focus is these days.
Yeah. Hey, and again, thank you so much for having me on. And dude, I just gotta just a shout out to your audience, because you and I were talking before we jumped on, you know, we've talked about this before, that it's so rare that people will take time to actually get the real information and then do something about that information to make a change in their life. And just knowing you, knowing your show, knowing what you represent and the folks that you serve, man, it is incredible to be able to talk to this audience, because I know it's the kind of audience that I would consider my people. And so anyway, happy to be here, man. And, you know, you said background and kind of where I got my start. So I actually grew up in California, lived in Germany for a couple years, moved to Utah, was going to school in Utah. And I found myself studying political science, thinking I was going to go in and become a lawyer. Like, that never was going to be a good fit for me. But at the time, that was just kind of what I thought. I got a job while I was trying to go to school and put, you know, food on the table, et cetera. And it was a job in mortgage finance. And I didn't know anything about mortgages. And as I kind of got to, that was sort of my first, I guess, exposure to anything real estate related. And as I started to kind of realize the tools that were available for people to be able to go and buy real estate, even with dollars that weren't their own, just utilizing leverage, I became really, really interested in the idea and ended up getting back together with some buddies of mine from Germany that were also here in the States. And we started a company with one specific intention. You see, this was like back in 2007. And what we saw is there were so many people that were out spending tens of thousands of dollars on real estate education courses, but they were never going and physically transacting real estate. And so just with all of I'd been in mortgages. One of my friends was a broker. One had done a bunch of investment real estate. One had a background in property management. We kind of were like the Avengers of real estate, right? Like, we came together and we're like, what if we could just not sell an education course necessarily, but what if we could teach people and then actually help them do real estate so that the dollars were going to the real estate instead of the dollars going to the education? And that was the genesis of the company. And now we've been at this for 13 years. As you mentioned, we've done over 4,000 properties with our clients. We've transacted over $500 million of individual single family residential investments with our clients. And we've got thousands of clients from coast to coast.
Excellent. No, and I can tell that's good. Well, and there's, there's nothing like helping someone achieve their goal, right? And just like we talked about it in the green room a little bit too, is that I'm a real big believer in helping people getting into the right deals, and making sure that they are, not making any big mistakes, right? That's ultimately why we even do this show to begin with. We want to try to inform as many people as we can to help them make the most complete decisions they possibly can. Now, with your business though, Kevin, how does your business work then exactly? Because clearly it's not like, just a regular, education type scenario. Nothing wrong with that. That's just not what it is.
Yeah, sure.
But you're helping people get into deals. Like how does that whole thing come together? How does it work?
Yeah, no, great question. So we have clients that find us from a whole variety of different avenues. And when they get to us, our job is to help them begin replacing their income one simple investment property at a time. And the way that we do that is I've kind of come to believe in this philosophy that if you want something done right, don't do it yourself. In fact, you should probably hire somebody that's maybe better at it than you, that's had more success at it than you. So for example, I'm not a good home rehabber, right? Like if my wife wants me to do a home improvement project, listen, it's going to cost twice as much because I'm going to spend all the money, put in all the time, still mess it up, and then have to pay the same amount or more to have somebody come and fix my mess. So I just skip that first step and I go hire somebody that's really, really good at it. It actually saves me money over time to do that. And that is a philosophy that we really champion. And so when our clients come to us and they're looking to invest in real estate, they're not necessarily real estate experts. In fact, the vast majority of them haven't really done much real estate other than their own primary residence. But they're looking at their 401k, they're looking at their retirement or their IRA, and they've done the math and they're going, hold on, wait a second. There's not going to be enough for my income to be replaced once I get to retirement. I have to do something different. You talked about it in the introduction. Most people don't have enough to be able to retire at their current level of existing income, especially once you account for inflation and increases in cost of living, right? And so what we do with folks is we say, okay, awesome. Listen, you've got some ground to make up, no problem. Real estate is maybe the only thing on the planet that allows you to make up that ground in a fairly short amount of time. So what we do is we help them put a plan together. An income replacement estimate is what we call it. Like, where are you at? What assets do you have? How much real estate would you need to get? And how long would it take you to get to income replacement? Once we have that plan together, we actually get them all pre-approved because we're going to help obtain the funding for them. We actually own a mortgage brokerage, and everything we do is we do single family residences. That's just our specialty. And so we get them the loan, we find them the property, we rehab the property, we place the tenant, and then we manage the property. And then we continue to work with the client so that after that property is grown, after 3, 4, 5 years, they can list it, sell it, and do a 1031 exchange and buy additional single family residences. So that's where the one property at a time comes in. So we call our company Done For You Real Estate because effectively that's the game, right? Somebody comes in, they have some ground to make up. We help them by finding them the property, getting them the financing, fixing it up, placing the tenant, managing the property. But our clients take 100% ownership of the property. They take title to the property. They make 100% of the gain, 100% of the appreciation, 100% of the tax benefits. Where we make money is we actually charge a per property flat fee as a separate buyer paid commission at the closing table only when they go to close on that property, meaning we've had to perform and deliver something that actually is going to be awesome. And that's where we make the vast majority of our money. Just, I don't care telling everybody what that is. We charge $4,995 as a flat fee per property, regardless of the purchase price, for our team to do all that work for our clients. And then we own the mortgage brokerage, so we make a little bit there. We also own a property and casualty insurance company, so we could do the homeowners policies. And so those are the three primary profit centers, which mean means we only make money when our clients physically transact real estate. And if we get a client that only does one property, it's very difficult for us to be profitable as a company and to succeed. So our clients, we have to do a good enough job that they want to come back and do it again and again and again, which so far it's worked out like 70% of the deals we do are all repeat clients coming back and doing additional real estate. But that's
Nice.
kind of how we do it and how we break it down and how we make money as a company.
Excellent. Excellent. So now what sort of areas are you covering these days then?
Yeah, so we the three areas where we're doing a lot of investing right now. In the past, we did a ton in Phoenix, we've done a ton in Las Vegas, we've done a ton in Utah. Right now, we're doing a bunch in Indianapolis, a bunch in Memphis, and a bunch in Orlando. Then we're opening 3 additional markets this year. And when we open a market, we have a team, boots on the ground in the market. We've got agents, rehab crews, property managers in the market that do all the work for our clients and hold their hands, as well as our corporate structure here in Utah that facilitates the whole thing and kind of oversees the whole machine. And so when we go open a market, we do a ton of research, very data-driven, very analytical. Then we go in, set up the market, do our own test deals there, then do some deals with clients who've done a bunch with us. Once we make sure that the system's totally dialed in, we open it up to our entire client base and to new clients. And so we got 3 markets that we're going to be coming on that are going to be coming online over the next 12 months.
Excellent. Because that's one thing you just covered a bit ago, is that finding the resources on site to fix the place up, to keep an eye on it, to vet the tenants, all that fun stuff. That's hard work, man.
Tough.
That's a lot of hard work.
Yeah, that's a lot.
Yeah, I mean, it doesn't matter whether it's single family, multifamily, whatever. Buying the deal is easy compared to running it for 10 years profitably. That's hard.
Yeah,
that's hard work.
We always talk about the difficult. Sorry to interrupt you. We always talk about the difficulty of transitioning from buyer to owner. It's something that not a lot of people consider. It's different to be a buyer than it is to be an owner, and to then manage that property and that investment business. And it's something that we really help our clients with, because when you lose that part of it, then you, like you just said, Augustino, you could buy all day, but if you know how to make that thing profitable and work for you in the long run, all you did is you created a purchase, and then you created another sob story about how real estate didn't work for me. So you have to have that other piece of it.
That's right. That's right. So let's take a step back then. So let's say, for instance, someone is interested then in investing in a house, in a single family, right? What sort of person are you trying to find to, or what rather, let's word it differently. What sort of person is actually coming to you with this vision of them getting into real estate? Like, how much money do they have? Yeah. What sort of person are they? What does a typical demographic look like?
Yeah. So the vast majority of our clients are between like 45 and 65. And they're typically hardworking middle-class Americans, right? They probably make somewhere between $85,000 and $150,000, right? So we're not talking about like super high-level C-level executives, although we have plenty of those that we've worked with too. But if I take like the cross section, right, it's 45 to 65, around $100,000 in income, and they've got maybe 100 to 150 that they've been saving for retirement over their 20 or 30-year career. That's in the 401k or in the IRA, or maybe even just in their home equity as they've been trying to pay off their primary residence. So they have kind of these secret assets that they're there, but they're not really liquid and they don't know how to utilize them. So we specialize in helping to make those assets liquid and then putting them towards these single family properties. And the properties that we do always fall between about $150,000 and $250,000. Typical stuff, like real vanilla, right? Like single family residence, 3 or 4 bed, 2 bath, good income type neighborhoods, high quality tenants that have good employment. We take a look at all of that stuff. It's kind of like blue chip real estate, not really cheap real estate, not really expensive real estate, not spec builds, just that the vast majority where Americans live, work, and play, that's the real estate that we help these clients do. So we're helping our clients buy homes in the neighborhoods that they would live in if they lived in that market where we're helping them buy, if that makes sense.
Well, it's also easier for them to understand it too, right? I mean, if they were buying like crappy houses in a not so desirable neighborhood, they might have a hard time trying to visualize anybody living there too, I would imagine.
Yeah,
right?
Exactly. Yeah, you're exactly right.
Yeah, there's plenty of those. There's plenty of those neighborhoods, especially in Indianapolis. I used to live there, so I know Indy quite well. And there's some places you just don't want to go. Yeah. And other places that are phenomenal.
Where that is.
You
Yeah.
got to know where that is. Exactly. And that's part of what you guys do, right? You're
Mhm.
vetting out those areas. You know when you have a good deal on your hands.
And we know which neighborhoods and inside of which zip codes, inside of which school districts are the ones that work, right? And there's plenty of real estate available if you've got a network of folks that can find the deals for you. And that's really the key, right? A lot of our clients, maybe you're on the West Coast, maybe on the East Coast, where, and even here in Utah, dude, like the median home price here in Utah is probably around 400,000. So if somebody's going to go buy a primary residence as an investment property, or not a primary residence, but an investment property here where they live in Utah, it's going to be 80, 90 grand as a down payment, if they're putting the 25% down, which is kind of what lenders require right now on investment loans. It's going to be 80, 90 grand to get an investment property. Well, that might be enough to buy them 2 properties in Indianapolis or in Memphis or in Orlando or some of these other markets, which is why we try to have the team and the framework so that now people can utilize the assets available to them and maybe even multiply the ability to grow those over time instead of investing where they live. In California, where I grew up, the median home price in my neighborhood which was not a super desirable neighborhood, right outside of Oakland. It's not great. I mean, it's like $700,000 to $800,000 for a little tiny, like 1,500 square foot, 3-bed, 2-bath house, right? Same thing with if you're in parts of New York, like upstate New York, not too bad. There's some stuff that is closer to the parameters, but man, if you're in Manhattan or you've got a really high paying, high powered job in a big center of industry like that, it's harder to buy investment properties the way we do it where you live. And so our goal is to help our clients buy in markets that they otherwise wouldn't have access to, which is why we have to know which neighborhoods, which price points, what type of real estate, what type of neighborhoods, what type of tenants to attract, what are the price points that are going to work, et cetera, so that we can make it as easy and simple and profitable as possible over time.
Right. So let's talk about the financing side, because you guys manage your own, you guys have your own brokerage.
Yes.
So it sounds to me like these are all investment loans, as you alluded to earlier. So this isn't the typical 3% down, you're quote living there and then you're going to leave after 6 months or whatever, right? You're not doing any of that stuff.
No, we're not. Yeah, no, there are people that, and that is not necessarily a bad way. If like you have no other way to get into real estate and you're like, oh my gosh, if I could just come up with 3% and then I could do it again, like, okay, cool. You can get an investment property for a lot less money out of pocket.
Absolutely.
But most of our clients, they're taking those assets, the home equity, the 401k, the IRA, the cash that they've been saving for who knows what, or they've got it in mutual funds or index funds or whatever, and they're going, it's not giving me what I want. And then they're putting 25% down right now, 25% to get these super low interest rates. Lenders just aren't as, during the COVID stuff, they're just not as excited about the 20%. Still available, not as open. You're getting a little bit of a hit on the rate. But these are all 30-year conventional, 30-year mortgages, 25% down. Super, super boring vanilla. But so we always say we help clients hit real estate singles. We're not swinging for the fences, because that could be great. You connect and you knock it out of the park. Awesome. But most of our clients, they maybe only have 1 or 2 good at bats in them. So if they swing for the fences and strike out, they may not get to the plate again, right? So we try to help them hit real estate singles time and time again. We play real life Moneyball. If you remember that movie with Brad Pitt and Jonah Hill about the Oakland A's, we help our clients play real life Moneyball with real simple real estate. That's kind of the goal. We're trying to help them get on base financially with real estate instead of just knock it out of the park. Because over time, that Moneyball mentality, you hit enough singles and get on base with enough velocity and consistency, you're going to win the game, but it's going to be taking on a lot less risk than maybe getting up to the fence or getting up to the plate, swinging for the fences. Maybe you connect and that's awesome and you've crushed it. I know that's a lot of what I know. You've crushed it time and time again, Augustino. I know a lot of the folks listening have crushed it, but for our clients, we try to keep them in the batter's box, taking the right kinds of pitches and looking to get a single and maybe even bunt it just to get on base, because that's how we make sure that they're going to be good in the short and the long run.
Well, I mean, it gets them into a deal, right? It may not be the most exciting, it may not be a little bit small deal, but you know what? At least you're in the game. At least you're on the field,
exactly.
That kind of thing.
Yep.
So when it comes to the rate, and I know that obviously this is a show, so it's like the rates are going to change, but they're typically going to be a little more expensive, the interest rate on an investment property compared to say one you're going to go and move into, right?
Sure.
In that example we just gave, like we're talking a couple points here, I imagine, right?
Yeah, you're talking low to mid threes on an investment property, and then mid to upper twos on a primary residence today. Right, that's right now. I don't know what that's going to look like in a minute. And with all the Fannie Freddie guidelines that just got released, if you're doing like a cash out refi or even a rate term refi, Fannie Freddie are assessing like a half point hit on these lenders if you're doing a refi. But on a purchase, you're not getting that half point hit. So you're like low to mid threes on an investment property on a 30-year like fixed, which is insanely good.
It's still very good. Yeah, I was going to say it's still good. It's not bad at all.
Yeah.
I mean, and typically if you're getting into a house in Indy, for instance, like I said earlier, and you said it was like, say $120,000, your monthly payment will probably be, if you put 25% down, I don't know, what, $700 or something like that.
Yeah. And you're probably renting it for $1,200-$1,300.
Yeah. So not bad. Not a bad little return.
Yeah.
Not a bad little
Not
return.
bad. I mean, you're looking at like probably a year one cap rate of somewhere between 6% and 8%. Right. So not bad. Your cash on cash return, probably ranges around the 4 to 8%, depending on the market. Right. And that's one of the things that we look at for sure. But we also look at, one of the most important numbers for us is the average annualized return. So if we look at, what you're going to generate in terms of cash flow, but we also take into account, principal pay down and depreciation. And then we look at recapturing that, but also taking appreciation into effect. When you go sell that property in let's say 5 years, we take that total pot of capital, right? And then we annualize that over the time that you've owned that property. And most of the annualized returns on the homes we help our clients do are between 15 and 25%. Obviously, it just varies by deal and by market, but that's pretty much where they all fall.
Wow, that's great. So how do you overcome, though? One of the things with these small deals is that if there's an issue, there's a problem, the guy vacates, so now you got a vacancy, all right? That could kill your return for an entire year, right?
It absolutely could. Yep.
So how do you protect that client, that investor from that type of scenario? How do you do that?
That's great. There's three main things. So the first, it all boils down to where the home is located. So one of the strategies is, if you buy right in the right neighborhood, it's the right kind of deal, it attracts a tenant frequently, right? And so even if you go vacant, you're not going to stay vacant for long. Now, that means it's got to be the right deal in the right neighborhood, and you have to make sure that that's vetted. Now, because that's not a guarantee, right? That's a let's hope we did it the right way. We have a couple other safeguards. So one of the safeguards is going into the deal right from the jump. We always have our clients set aside anywhere from 3 to 6 months worth of payments in what we call a sleep well at night account. And that is to not be touched, right? That is in the event that something happens, you've already set the dollars aside. They're already there so that you could cover 3 to 6 months worth of rent. Now, the other thing that we do is, in addition, whatever you're paying in terms of a property management fee, which usually equates between 8 and 10% of the gross monthly rent, we actually say, okay, whatever you're going to pay to the property manager, let's also set it up so that you're automatically depositing that amount into your sleep well at night account, right? So you're continuing to pad the account, which also could be there for ongoing vacancies, but also repairs. So we try to go into it with eyes wide open, full of preparation and understanding. Look, real estate is never perfect. In fact, real estate's always challenging. The way that it feels less challenging is when you prepare properly. And so that's what we do. So there's never any guarantees, right? But if you buy it the right way in the right neighborhood, and if you have that sleep well at night account, and if you continue to contribute it to it, and then even if and by the way, those returns that I was talking about earlier, that cap rate, that 4 to 6 or 4 to 8% cash on cash return, those are numbers assuming that that's everything that it cost you to get into the property, right? Your total out of pocket, we always say, is down payment plus the fee that we charge plus your rehab expenses. And then you're getting your cash flow, but out of that cash flow, you're setting aside that 8 to 10% for vacancy and repairs, and that 8 to 10% for property management. So you're effectively, that cash flow and those numbers are still with taking anywhere from 16 to 20% out of the rent that you're collecting right off the top. And then you're still getting those numbers that I mentioned earlier. So all of that for us is just, how do we keep it as conservative and as, just simple as possible, saying, look, this is not going to be a get rich quick. This is not, you're going to get a deal, you're going to crush it, and then next week you're going to be a multi-billionaire. This is like, look, this is simple and conservative real estate in good, predictable type of markets, one property at a time, over time, in order to achieve a level of income replacement. So it's all of that combined is how we try to protect our clients. It's not a guarantee, but we feel like we're doing everything we can.
Right. And, and just like we said earlier, it's like one of those things that at least you're in the game, you're on the field, you can get started. It's a place to start, right? Because for many folks has never bought a single family ever in their life, right? So it's like, at least if you buy a single family, or I imagine, Kevin, you're doing duplexes and up to fourplexes, I assume, right?
Yeah, we do some of that, but the vast majority of it is SFR. Yeah.
I mean, there's more of them out there. There's more availability
right.
for those types of deals, especially in Indy. If I remember, unlike some of the older markets, you see a lot of more duplex and triplexes. But in Indy, I didn't see too many of them when I was living there. But maybe I just wasn't looking. I don't know.
Yeah, and most of the neighborhoods we're going to are pretty much all single family residences, because that's just part of the model, right? That's just the model that we've seen work in every economy for the last 13 years. And so we just kind of stick to what we know, I guess, right? If it ain't broke, don't fix it, right? So that's kind of the for us and for our clients, it's been a good conservative approach.
Right. Well, I mean, and just for that price range, you're not looking at terrible. I shouldn't say terrible, but neighborhoods that are not as desirable. For instance, you're looking at, sounds to me like, a B- type of area, so it's
exactly.
not, it's a little bit better property. It's a nicer property.
B-type properties is exactly what we're looking at. We don't want A's, we don't want C's, but we're cool with the B's, right? That usually works pretty well.
Yeah. And I imagine that many of those folks that rent there are going to be there for maybe 2 to 4 years, I would think, right?
Yeah. And the other thing that's cool is if you find the right type of tenant, you're in the right neighborhood, a lot of times you've got a built-in buyer, right? So not that we're doing like a lease to own or a rent to own, but a lot of times these clients go on to actually be the ones purchasing the home from you, because we'll let them know, right? Like if they've rented long-term and it's time, you've looked at it and you go, okay, man, my equity's grown. It might be a good time to sell and 1031 exchange and grow my portfolio. We'll let those tenants know, and they may be in a position where we can help them actually transact that property. So now you've got a built-in buyer, and you don't have to go and battle the rest of the market to try to find a buyer if you're going to sell at that point. So that's worked pretty good too.
Yeah. Well, it's very low friction. The guy's already there. Right. He's already moved in.
The kids already have the stuff in the closets, right? You know what I mean? And so he's already mowing the lawn. Why not continue to do it? And then that's kind of the mentality. Yeah.
Exactly. I love it. All right. So Kevin, if you had that one piece of bulletproof advice for that person listening right now, what would you tell them?
I would tell them, and this may be a little counterintuitive to what a lot of people say, but this is what I would tell them, okay? Especially if they are a beginner, all right? Stop swinging for the fences. Meaning, I'm not saying you can't 10x your results. I'm not saying that you can't go out there and crush it. I'm saying go hit a single, get off the bench, get in the game, get on base, because as soon as you get that taste that's required probably less money and less risk out the gate, once you get that taste, you now put yourself in a phenomenal position. Real estate is one of the only things that can truly make you wealthy over time, but it's got to start somewhere. So instead of waiting for that perfect deal, instead of waiting for the perfect pitch so that you can crush a grand slam, get off the bench, go hit a single, get on base. Just don't worry about swinging for the fences. Just go get on base. And that would be the piece of bulletproof advice that I would give anybody as they're considering their real estate portfolio and how to take it one step further.
Love it. All right, guys, if you want to reach out to Kevin, get him at his website, dfyrealestate.com. It's dfy-realestate.com. I hope you got some insight on how you can put your money to work increasing your income with these cash flowing single family assets. It could be a very good way for anyone just starting off that really, really wants to get into this business. All right. Perfect way to check it out. So reach out to Kevin if you think it could offer you some value. All right. So thanks for tuning in, guys. And I will see you in the next episode. Take care.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.